The mistake that a lot of people are making regarding real estate, and that is that population, all the immigration is going to solve the problems of a deflating credit bubble. But that is without looking at history. And what's interesting, this is a chart this is from the U.S. And what I like about the U.S. data, I don't think there's anything here in Canada, but if you look at the bottom there, this is a interesting chart because it really reflects, real estate, right? How can people afford, and what would drive prices higher? And the assumption is always population growth, but that doesn't take into account income. And in Canada's case, it's been stagnant in real terms, interest rates, which has been falling, and of course the price of real estate itself. I mean, those would drive supply and demand. But I'm going to show you something that's interesting because new demand is going to change dramatically and it will impact the future. And as always, you're going to see unique charts you probably have never seen anywhere else. That I'm pretty sure of. So this is a chart, and I've looked at all the data, right? This is a long wave. This is not based on data in the past 2 years, 3 years, 5, 10. It's all the data possible. And if I can get as much data about Canada, the more relevant, the more accurate the information is. All this is, take the ages of 30 to 34, and this is usually the latest they'll be purchasing a home. And I spliced in the data from Stats Canada and, of course, the UN prospects for growth into the future. And then I'm going to show you an actual chart from Canada, Stats Canada itself. Now, this is in logarithmic format. So if you notice here, we're having a nice growth. Notice the trend line. It was rising even though we had a real estate collapse in the 1930s and the 1880s. The net demand was there until about 1991, and then we had our first really great real estate bear market here in Canada during the 90s. Some people here are too young to remember that, but basically the idea of real estate going up was destroyed after that period. Now, what's interesting is the next cycle is to peak here about 2024. This is the data from the UN, of course, right? And we're seeing the demands is slowing, and it's just very logical, right? Very logical when we think. Now, here is the age group, and I just got from Stats Canada. Medium growth, again, in the future, we're not going to assume that we're going to have past low growth immigration or assume that the fast growth will continue, because when the economy turns down hard, there'll be pressure to cut back on immigration and restart it after economic winter. But you can see even with this data that the amount of 30 to 34-year-olds it will peak into the next business cycle. Now, the problem is that there might be a demand out there where people can't afford it, so prices have to fall because of high prices and interest rates. So that will drive down prices, and that will only accelerate the downturn. So what I'm suggesting is even during the 1990s and the great real estate bear market, there still was transaction. Prices just fell. And there's nothing wrong with that. And we need that for the next generation for prices to fall. Now, here's the chart really that I want to focus on. You've never seen. It's a very unique chart. And what I took here was all of the population data I could find, of course, some Stats Canada, and then some of the data from Angus Madison's historical statistics of the world economy, spliced it together, and then put an exponential trend line. And what you can see, something unique happened after World War II, and we've had a runaway from the exponential trend line about 1952. And that continued until 2001, and it actually started to slow. Now, what's interesting, we've had the greatest credit bubble in that period that it fell below. It fell below the growth rate. So to suggest, and I've showed this with other charts, that what was driving real estate was population growth is a fallacy. The immigration wasn't there with the birth rates, as we all know, have plummeted. It simply was inflated, as with all asset bubbles, with cheap credit, right? And we had the blow off in 2020, 21 with interest rates at a 5,000-year low. That's it. So now we're in a secular bear market in real estate prices. And I posted today how long it's going to last. According to the long wave model, the 2030s. This demographics points to it. Now, remember, I also haven't shown you the death rate because the front end of the baby boomers, right? The largest generation in history will be putting supply onto the market. And you have to take that into account. A lot of people aren't. So this is another interesting aspect. And again, I'll be adding small charts. And then that way you can see what is occurring. And as always, the website, you can have access if you want to contact me. A lot of people are asking, and this is growing, and I'm a little bit overwhelmed. It's actually growing a lot faster, thank you very much, than I anticipated. So that's a good sign. But again, if you want to have access to the Canada's long wave model, you can find it at Substack. You can find everything at the website, how to contact me or reach or follow me, any of the social media. The Substack account will be simply focusing on the markets. And for subscribers, the obvious thing is I'm going to, everybody knows how they got to know me. It was bearish, extremely bearish on real estate. There's no impetus behind to drive it in the future. Just the headwinds of rising interest rates. And they're going to go much higher than anybody thinks. I will explain why in the future. Also, subscribers, there is another asset which I won't allude to that we're avoiding like the plague. And it ties in for why I believe interest rates are going to go much higher. Okay. Oh, just to explain, and I promise over the next week, I'll explain the long wave model. So you understand how it works, because a lot of people are asking me, how does it work and so forth. I designed it for myself because I'm a baby boomer, and realizing that we're coming to an end of a secular bull market, right? We're about to complete the fourth turning and come across economic winter. And Japan went through that in the 90s, where it had a systemic collapse in real estate and stock market prices. And that's our future also. And this is normal, right? There's the regenerative aspect of the long wave. A lot of people don't like it. I don't like it either, but it's time to pass the baton, right? The younger generation is going to build on the new technologies in the world. I mean, everything will have to collapse because the education system is not sustainable, the sick care system, the political system, the monetary system. It no longer serves the real economy. All we're doing is going into debt to try to sustain a system that could no longer work. And now we're hitting that wall, right? We're hitting that wall with rising interest rates. So the model, as I said before, it's actually really simple. It's driven by three things: the long wave, the construction or the Kuznets real estate cycle, and the business cycle. And those are all turning down. And that is causing the portfolio to allocate accordingly, right? It's not a trading account. It's an account basically that might change at most 4 times a year. Usually at most, let's say over the past 7 years, twice. That's really would be the norm, only because you get a bull and bear market opportunity to displace assets and purchase assets, right? We're not wanting to have any kind of losses, but I'll get to that in detail. But here's the giveaway. The assumption, again, going back to this, is remember that population growth did not drive real estate prices. Doesn't make sense, because if you look at it, followed the exponential trend line. Then 1950, it just exploded. And then in 2001, it actually started to slow and fell below the exponential trend line, yet we had a massive credit bubble. But what occurred? The falling price of credit. That's what drove it, right? That's what made it affordable. Because if interest rates went to 21%, I would theorize that most mortgage holders couldn't afford their home. They'd be forced to sell it. And that is a high probability into the future, which we'll discuss. Okay, so I hope that helps, and I hope you enjoy the latest unique chart perspective, historical long wave. This is what we do different here. It's a perspective using all of history to make a forecast, because the long wave is a social cycle, right? It's a reflection of you and me and society and politics and economics and technology. It's not, it can't be controlled by central banks or governments. They cannot stop economic winter. They cannot stop the fourth turning. This I'm going to, drill in. And when it happens, they will be discredited, basically, because their solution was more debt to solve an over-indebted problem. That's what Canadians have. We have too much debt. And that needs to be restructured, defaulted on, bankrupted. Asset prices need to correct dramatically so the next generation can purchase a home. Because it's impossible for millennials, the tail end of millennials, to purchase a home. Impossible. Only the wealthy could buy one home. And that's not because Toronto or Canadians are creating real wealth. We've just created a Ponzi bubble. Okay? Hope you enjoyed it. Please leave a comment. I read them, and if I can respond to them, and if it's regarding the markets, head over to Substack. That's where you'll get information what to do with the capital. Because during economic winter, it will change a lot. I don't know if we're going to get the typical 3-year collapse and an 18-year bear market where you trade like Japan in the 1930s and the 1870s. That's a possibility. That's my concern, right? But right now it doesn't look that way, but we will see. So as always, thanks for listening.